turn yourself on mute if you don't mind. We want to minimize the background noise. But we'll get things kicked off here. For those who have joined, I think we're going to have a couple of stragglers coming in here in the next few minutes. But appreciate you guys setting aside your lunch hour to join us today. This is the first iteration of a monthly webinar series that we're doing with Friedel Financial and JSM Financial. For those of you who don't know, we've merged recently, and we now have 250 clients, I believe, under management since we went through that merger. So we're super excited to join our businesses and to offer you guys more value. When we go through a merger like this, it just means that we can increase our service offering and get back to you guys a lot faster than previously, just because we have more hands on deck. So we're super excited, and I know we've had some great feedback so far. For today, topic of conversation, we're going to be going through some tax and estate planning. If you guys are following me on social media, you'll notice that I've put out quite a few different posts on a recent event that I'll be talking about. We're going to kick things off with a bit of a case study and talk about the importance of estate planning, and if you don't have an estate plan, the ultimate cost. You also may have seen that we're going to be doing a bit of a giveaway, so we'll go raffle style. We're going to have an RSP trivia question, and for those who answer the question correctly, I'm going to enter you into a raffle for the opportunity to win a gift basket, which includes some wine and some snacks. Afterwards, as you can see here, I have a colleague of mine. So for those who are unfamiliar, you may know, you saw a couple of logos here on the previous screen, Friedel Financial, JSM Financial, and Desjardins. So for those who are confused why I'm featuring Canada Life, it's because I'm fully independent. So I'm not married to just using Desjardins for our service offering. We have, partnerships with investment and insurance carriers all across Canada. So Wilmot is a representative from Canada Life, who's the managing director of tax and estate planning. So he's going to take us through some key aspects that are absolutely vital in terms of having a part of your overall estate plan. So Wilmot will spend about 30-40 minutes going through some key solutions, and then we will leave some time open for some Q&A. For anyone who's already submitted a question, we'll do our best to get to it, but we will leave the floor open if you want to ask it live. If you do want to ask along the way, if there's anything confusing about the slides, or if there's anything top of mind that comes up as Wilmot goes through his presentation, feel free to raise your hand, or simply just take yourself off mute, and we can make sure we get those questions answered. So kicking things off, we're going to start with a case study. You may or may not have seen this online. It's been a hot topic as of late. There was a family who got hit with a $660,000 tax bill simply because of improper planning. I talk to people all the time, especially when we're looking at, moving from retirement planning into estate planning. One of the biggest conversations and eye openers is for people who have large sums of money in their RSP. And what's often not talked about, especially if you've been dealing with primarily, I'll pick on the banks because I find the banks don't do the best job of educating their clientele. A lot of people don't realize that RSPs are 100% taxable. So whether that means if you're taking money out of your RSP through the form of a RIF, or you're taking monthly income from your RSP, or if you happen to pass away, that money is 100% taxable. And the way that our tax brackets work in Canada is the more money that you make, the more taxes you pay. So if you have, in this case, the family had $715,000 in RSP money, that was taxed as income in the current year. So 100% of that money is taxable, which means a 50% tax rate. So a very unfortunate scenario. The other side of this was the family had a family cottage as well as a principal residence. 5 years prior to death, they actually moved into the cottage and reconsidered it their principal residence. However, unbeknownst to them, the CRA still wants their capital gain tax money. So even though they moved into the property as their principal residence, the CRA still wants the money or the capital gains taxes that were applicable between when they purchased the property to when they actually moved in and considered it their principal residence. So all in all, second property, RSP, very typical scenario for many Canadians and probably some people on this call. Extremely important to make sure that you have a proper estate plan in place to make sure that you're not giving too much money away to the CRA. Nobody wants to give the CRA 50%. A lot of you probably don't even want to give them 10%. So our job is to make sure that we give you the right plan in advance so that you don't end up in a scenario like this. Okay, so before we send things over to Wilmot to go through some of the solutions on how you can potentially avoid that scenario, we've got a giveaway. So I've got an RSP trivia question for you guys. I did hint at the answer already, but what I'm going to get you guys to do is if you can access the chat function in the call, then you can just send in your answers for what you think the right answer is. If you get your answer correct on the first try, I'm going to enter you into that raffle for the opportunity to win that gift basket. So the question is, when someone passes away with $500,000 remaining in their RSP, how much of that amount is typically subject to income tax on their final return, and under what circumstance could that entire tax liability be deferred to a later date? So options are option A, only 50% is taxable because of the capital gains inclusion rate. Option B is 100% is taxable as income on the deceased final return, unless the RSP is transferred to a qualifying beneficiary, such as a spouse or a financially dependent child. C is RSP money is tax-free if the deceased person had a will, or option D is the RSP automatically becomes tax-free if rolled into the estate trust. So I'll get you guys to give a couple minutes to think about this one. And if you can just, you can simply just write the letter that corresponds with the correct answer. And I'll get you guys to enter that into the chat.
I don't know how to do it.
All right, so here's the explanation. Okay, so reason why it's answer B is because RSPs are fully taxable, as I mentioned, as income in the year of death, unless they're transferred to a spouse, common law partner, or financially dependent child or grandchild. In those cases, the tax is deferred until the beneficiary either withdraws the funds or they pass away themselves. And that was the scenario in the example I gave, where both parents passed away. Initially, there was that spousal rollover condition, and then the second spouse passed away, so the daughter was left to deal with that $660,000 tax bill.
Really appreciate the time and the opportunity to speak with you and your clients today. I always enjoy the opportunity to come out and talk about this stuff. I've been in the industry for a number of years, well over 20 years. I've had a chance to present from coast to coast, and I say that just to suggest that, you know, I've met with many investors and many advisors over the years, and for whatever reason, people don't like talking about death, right? Look, I get it. You know, it can be, you know, morbid kind of topic, but the truth is, there are two certainties in life, right? Taxation is a certainty in life, and death is a certainty in life. So the way I kind of look at it is, there's no question about whether or not we're going to die. There might be some question about when that's going to happen, but we're all dying at some point in time. So the question really becomes, do we put some plans in place to ensure that our assets get handled the way we want them handled? And that could mean tax minimization. That could mean distribution of assets to intended beneficiaries. That could be minimizing conflict within a family after a death. Or do we not do any planning and leave all of this to chance and perhaps see our assets go away to unnecessary taxation, unnecessary legal fees, or distribution of assets to unintended beneficiaries, right? So, you know, I think it's important to put an estate plan in place. And when we talk about an estate plan, we're not necessarily in all cases talking about long, drawn out, complex, sophisticated planning. Sometimes estate planning can be something as simple as having the right provisions in your will. Sometimes estate planning can be as simple as, you know, having named beneficiaries on registered plans to allow you to bypass the estate for probate purposes and to ensure assets go to beneficiaries directly and in a timely way. Sometimes estate planning can be just ensuring with a cottage property, for example, secondary taxable property, that you're claiming all eligible capital expenditures to bump up the ACB on that property to minimize capital gains tax at the time of death, right? There are more complex, sophisticated strategies, and then there's some simple stuff, right? And what we want to do over the next, I don't know, 35, 40 minutes or so is we just want to have a very informal, candid conversation about death and taxes and estate planning. All right. So I invite everybody to relax, take it easy, just kind of try to absorb some of this content that I'm going to share with you. It'd be my pleasure to answer any questions that you have to the extent that I can. If I can't answer your question on the spot, it'd be my pleasure to work with Bronson and yourself offline to get answers to your questions. Okay, so very formal, informal atmosphere I like to create when we do these types of talks. Okay, so my agenda here is I'm going to go through the importance of estate planning. And estate planning can mean different things to different people. If I was to ask those participating on this call to define estate planning for me, I would probably get 10, 12, 15 different answers because it can mean different things to different people depending on your personal situation. So we're going to talk about the importance of estate planning. We're going to talk about what that is, and we're going to talk about the benefits of it. We're going to talk about taxes and fees at death. Because a lot of folks across this country don't realize that taxation can apply and often does apply at the time of death. And for those who do know that there's some form of taxation at the time of death, do they know specifically what that taxation looks like? Primarily, we're talking about income tax at the time of death, and we're talking about probate fees. I'm assuming all attendees are residents of Ontario. If not, let me know. But probate fees quite often are a reality for Ontario estates. So we're going to talk about income taxes. We're going to talk about probate, the probate process, and what those fees might look like. And then, of course, we're going to talk about some strategies for reducing those things, right? Strategies for reducing income tax at the time of death, strategies for minimizing probate fees at the time of death, and or managing the distribution of assets. Okay, and then we're going to close with 2 or 3 slides that talk about the role of the executor. When we sit down to draft a will or think about who's going to manage our estate when we die, most folks know that we should name an executor. But what more do we need to know about that? Are there certain persons that might not be a good fit as an executor? Are there certain persons that would be a good fit as an executor? What is the role of the executor? What are some of their duties? Is the executor responsible for taxes for a deceased estate? Does an executor become personally liable? These are some of the things that we're gonna chit chat a little bit about towards the end of the presentation, and we'll go from there. The truth is, we could spend 3-4 days in a course to talk about the stuff that I'm going to try to cover over the next 30 minutes. All right, but what I'm going to try to do is stay high level, just point out some key things that I believe that Canadians should know about this estate planning conversation. And then if you have follow-up questions after the webinar, I encourage you to reach out to Bronson and his team to help you with those questions. Okay? All right. So let's move on. The importance of estate planning. Well, the first question is, what is estate planning? I think most would understand that it has something to do with death and putting some type of plan in place to manage assets at the time of death. Now, we have the National Institute on Aging, which is an organization out there that puts out papers, does some research as it relates to aging in Canada. And this is how they, in collaboration with RBC, this is how they define estate planning. They say it's the process of organizing one's estate, which is everything an individual owns or owes, assets, or liabilities, and establishing a collection of legal documents outlining how the estate should be distributed in the event of death. Okay, but it's more than that. Estate planning also includes establishing how financial and health decisions should be managed while the individual is still alive in the event of incapacity. So not only does estate planning encompass those things which might happen when you die, we often forget that estate planning also includes managing our health and our assets should we not be able to speak for ourselves even while still living. We often talk about wills, and when you go establish your will, talk to your lawyer, name your executor, name your beneficiary for your assets, and so on and so forth, and all that's important. But tax practitioners, estate planning practitioners would also suggest that when you go to establish your will, also establish power of attorney documents to speak for you should you be living but not be able to speak for yourself. Power of attorney document for financial assets, power of attorney documents for healthcare decisions, that type of thing. Okay, so an estate plan is the written record that sets forth these wishes. Okay, fine. Why is estate planning important? By proactively making decisions and taking those necessary steps to ensure one's plans and wishes are clearly known, outlined, and carried out in the event of illness or death, estate planning often provides individuals and their loved ones with, here's the key, peace of mind. So if I take the time and I sit down and I think about my family and I think about my assets and I think about the transitioning of assets when the time comes, and I put some plans in place to ensure that everything is going to go the way I intend for them to go, if I put something in place and know that if something happens to me and I'm ill and I can't speak for myself, the appropriate person that I want to speak for me will speak for me. If I know all these documents are in place, it allows me peace of mind. I'm sure all of us on this call have been in a situation before where we have something nagging us in our mind. I got to do this. I got to do this. I got to do this. And it doesn't matter, day in and day out, and day in and day out. Doesn't matter how busy I am during those days. That nagging thing sits at the back of my mind. I know I got to do this. I know I got to do this. That is not peace of mind. Right? And estate planning and putting in place certain documents, such as a will. It's amazing that once you do that and you're comfortable with it, all of a sudden you have a certain level of peace of mind because you know that it's in place, right? So this is why it's important to talk about these things, understand the potential challenges that can present themselves when we're dealing with the distribution of assets. If we put certain things in place, it will offer us peace of mind. Okay. Now, estate planning, common objectives. What do people often try to achieve when they put an estate plan in place, when they're considering their estate plan? They often want to provide an inheritance or a future income stream for dependents and other family members. They quite often want to maximize assets for their beneficiaries. Quite often, they want to provide funding for estate expenses, including taxes and administration fees. Quite often, they want to minimize taxes of death and fees, which in turn maximizes assets for beneficiaries. Quite often, they want to control and protect assets after death. Perhaps I don't want to leave $100,000 to my 18, 19, 20-year-old son directly. Because if I do that, a shiny red sports car shows up in the driveway the next day, right? Perhaps I'd rather leave my 18, 19, 20-year-old son $10,000 a year over 10 years. How can I achieve that? We're talking about control and the protection of assets after death. We can engage the estate planning conversation to figure out how best to protect these assets. Perhaps I have a child or children living with disabilities, and I know that they will not be able to manage assets long term, but I want to provide for them for as long as I can, even after death. How do I do that? It's part of the estate planning conversation. And perhaps when you sit down to define your estate plan, you want to clarify and confirm your distribution plan, who should receive the assets and how. So these are all common objectives. When folks sit down to establish an estate plan, they often think about these things. Now, when building your plan, consider these steps. I'll point out 5 steps here that you should consider when building your plan. Number 1, work with your advisors to set realistic goals. None of us know everything. And as much as I appreciate and admire do-it-yourself research and work, because I believe in that to a certain extent, none of us can know everything. And everything that you read on the internet is not necessarily factual or suited to your own personal situation. And there is value in experience, having walked the walk, having been through situations, having spoken to clients about different things. This is why we suggest when you consider your estate plan, work with your advisors, financial, accounting, and legal, to identify tips and traps, and also to help you to set realistic goals. All right. Number 2, determine which tools fit your situation. Is it a will? Is it power of attorney? Perhaps it's the implementation of life insurance if it's not there already. Perhaps you need a formal trust to help you to control assets, before or at death. Perhaps named beneficiaries on registered plans make sense as part of your estate plan. So you want to determine which tools fit your situation. Number 3, choose who will speak for you if and when you can't speak for yourself. Yes, I'm talking about determining your executor to manage your estate when you die. I'm also talking about attorneys for your health or property. Power of attorney documents will appoint an attorney to speak for you. Should you be away, or should you be not able to speak for yourself due to illness or disability, right? I'm talking about guardians for minor children or grandchildren in your care. Who do you recommend or suggest provides care for those children after you're gone, right? I'm talking about trustees for any trust that you establish, right? You want to choose who will speak for you if and when you can't speak for yourself. And number 4, you want to communicate your wishes. I certainly understand the value of privacy. I certainly understand that sometimes you want to keep certain things to yourself. But quite often when we talk about putting an estate plan in place, quite often it makes sense to share that plan with others. So you create a will and you name an executor. And then you put that will in that very special spot where nobody can find it. And you didn't communicate to your executor that they are to be the executor of your estate. And then you die. Nobody can find a will. Nobody knows who your executor is. Family members don't know what's to happen with your assets. But often it makes sense to communicate your wishes to those who need to know certain things, so that if and when the time comes where they might need to act on that, they know where to find certain things. They have a sense for what your wishes were, so that they can carry out your wishes. All right. So communication is important. And then step number 5, keep your plan up to date. Right? People's circumstances change. Relationships, relationships and families grow. Relationships and families break down. Preferences change. Markets change. Right? All types of things happen over time. So you want to make sure that your plan stays current. When it comes to wills and power of attorney documents, we suggest having a look at your will and POA and make sure it's current every 3 to 5 years is a good idea. Treat it like your investments, right? You want to talk with your advisor periodically to look at your investments and see how they're doing and so on and so forth. Well, you know what? You want to keep an eye on your estate plan as well. You want to keep an eye on your wills and POA documents and make sure that they still speak to your current wishes. All right. We quite often recommend every 3 to 5 years. Okay. All right. Cool. So let's move on. Let's get into some fun stuff here now. Let's get into some of the technical aspects of estate planning. And what I want to do first is talk about taxes and fees of death, right? Because there are many Canadians who don't fully understand what taxation looks like at the time of death. They don't fully understand some of the fees that can apply at the time of death. There are many folks that suggest that Canada is a highly taxed country. It taxes its residents significantly. And there's some element of truth to that, right? Although Canada is not the only country, but there are elements of truth to that. We know that self-employment income is subject to tax. We know that investment income generally is subject to tax, unless we're talking about a TFSA that has limits, right? We know that when you go out and you buy stuff, they get you with the GST, PST, HST, depending on the province that you live in. And then when you die, what happens when you die? Well, income tax normally applies at the time of death as well, right? And I'm going to show you how. Now, before we get into how assets are taxed at the time of death, it's important to just kind of revisit Canada's tax system as a whole. Now, this slide that you see here is a very busy slide. Lots of numbers on this slide. You don't need to pay attention to the whole slide. What I'm going to draw your attention to here is the left side where it shows taxable income, lower and upper limit, and then the column there that says rate on excess. Okay. So what this slide is telling us is, in brief, if I just kind of summarize it here, as your income increases, your tax rate's going to increase. Canada's tax system is a graduated tax bracket system, a self-assessment system that is a graduated tax bracket system. The self-assessment says that the government expects Canadians to look at our own individual situation and accurately calculate and report and pay our tax liability. That's the self-assessment part. The other part is graduated tax bracket system. That means as our income grows, our tax rate will increase. So for example, if my income is between $0 and $16,000, I'm not taxable. My tax rate is 0%. Income between 16 and 18 is taxed at 14.5%. This is Ontario. 18 to 24 is 24.6%. Then you see it drops to 19.5. Ignore that. There's just a low income tax reduction that gets clawed back, and that's why you see a little bit of a dip to 19. But the point is, as your income increases, your tax rate increases. Now, there are two things that jump out at me when I look at this slide. The first thing that jumps out to me is that I realize that those who are fortunate enough to be subject to tax at the top tax rate, the top tax bracket, meaning you're earning more than $253,000 in a given year as an Ontario resident, your tax rate for income beyond that is 53.5%. In other words, for those who are fortunate to have that level of income, once you hit that point, each additional dollar that you earn, the government earns more off of you than you earn off of you. Okay? That's the first thing that I notice when I look at this slide. Some would consider that to be an issue. Right? The second thing I notice when I look at this slide is I realize that throughout an individual's lifetime, and in many cases throughout retirement, we're subject to lower tax brackets and lower tax rates in our lifetime, in our retirement, maybe 23%, maybe 29%, maybe 31%, what have you. And then when we die, a large portion of our wealth ends up subject to tax at 54%. Okay, so I'm going to say that again. Throughout our lifetime, throughout retirement, quite often, we're subject to lower tax brackets, lower tax rates, because that's just where our income is, maybe 29%, 31%, 33%, what have you. And then when we die for the year of death, a large portion of our wealth might end up being subject to tax at 54%. Okay? So the question is, why is that? How does that happen? Well, Canada says that just before we die, we're deemed to have sold or withdrawn our assets. So let me set the stage here for a minute. Let's assume that I go out and I buy some asset. Maybe it's stocks, bonds, maybe it's mutual funds, maybe it's a vacation property. I go out and I buy an asset. And let's say, just to use round numbers, $100,000. And then I sell it sometime in the future for $150,000. That's a $50,000 capital gain that gets reported on my tax return for the year that I sold the asset. And I got to pay tax on that capital gain because that capital gain is income and we're subject to tax on our income in Canada, income tax, right? Okay. Now, let's say that I buy an asset for $100,000, it grows to $150,000, and then I die. What happens there? Well, the government says that I sold that asset just before I died. So I have a $50,000 capital gain that I need to report on my final tax return, my terminal tax return. My executor needs to include that $50,000 on my terminal tax return. In other words, the government gets you before you go. All right? So what happens is with our non-registered assets, stocks, bonds, real estate, they're deemed sold just before death. So the same way we would have to pay capital gains tax when we sell an asset, we would have to pay capital gains tax at the time of death because the government says I sold it just before I died. Okay, that's non-registered assets. Well, what about our RSPs and our RIFs? Bronson talked about this earlier on. What about our RSPs and our RIFs? When we contribute to RSPs, we claim a tax deduction up front. The money grows in the RSP on a tax deferred basis, and the government expects us to pay taxes on that money when we withdraw it from the RSP or RIF. So if I don't have a chance to withdraw this money, if I die before I withdraw my RSP or RIF, what happens at death? Well, the government says that I withdrew the entire amount just before I died. So if I have a $400,000 RSP or RIF and I die, $400,000 is added to my taxable income for the year of death, which, by the way, exceeds $250,000, which puts me at the top tax rate and the top tax bracket. So a large portion of that RSP or RIF, if not all of it, depending on total income for the year of death, ends up subject to tax at 54%. A lot of folks don't realize this. This is why estate planning can help. Estate planning can reduce exposure to tax at 54% when we die. All right? So that's income tax. But then there's this thing called probate that might apply. Probate is provincially governed, levied, right? Each province has their own rules around the probate process. What is probate? Well, I'm going to use an example to illustrate what probate looks like. So let's assume I own an asset. Maybe it's an investment asset. I own this investment asset at call it my company, Canada Life, for example, right? And it's in my name solely. I have a will. My will says that my brother is my executor when I die. My kids are my beneficiaries. So I die. My brother knows where my will is because I told him where it is. He knows the executor because I told him I want him to be my executor, right? He goes to the will. He sees that's the case. He contacts Canada Life. He says, hey, Wilmot's got this account at Canada Life. He just died. Canada Life is going to say, sorry for your loss. New Wilmot, great guy, liked him a lot, right? My brother's going to say, yep, passed away. Here's his will. I'm the executor. He has this account at your financial institution, and you can see his kids are his beneficiaries. And we'd like you to transfer this account to their name based on his will. Canada Life is going to say, thank you. Can see that you're the executor, can see that Wilmot's kids are his beneficiaries. But because of the value of this account, we would like to see a probated will. So my brother now has to take that will, contact the Ontario government, right? And the Ontario government's going to look at the will, confirm that it's a legitimate will, and confirm that my brother has the authority to distribute my assets. So they put their stamp of approval on my will. My brother then takes that probated will, goes back to Canada Life and says, here's your probated will. Canada Life says, thank you very much. That's what we wanted because it helps us to protect us from risk. And will now transfer the account to somebody else's name, the beneficiaries under my will, right? That is the probate process. The big question, though, is do you think that the Ontario government puts their stamp of approval on that will for free? They don't. They charge a fee, right? And that fee in Ontario is based on the value of one's estate. So if the estate, the total value of the estate is less than $50,000, there's no fee. But if the estate is greater than $50,000, it's 1.5% of the amounts in excess of $50,000. So if your estate is valued at $1 million, your probate fee is $14,250. If your estate is $3 million, $44,000 is your probate fee. If your estate is $5 million, $74,000 is your probate fee. And that's in addition to any income tax payable at the time of death. So you can see that income tax and probate fees can really take a bite out of the assets available to your beneficiaries, right? I'm just taking a look at the time. How are we doing for time there, Bronson? We good?
We're good. Yeah, I'd say let's go another 10 minutes, and then we'll open up the floor to some Q&A. My question to you, though, Wilmot, do you have any numbers with regards to additional costs at death, such as accounting, legal fees, et cetera?
Well, it depends on the circumstances, right? And you're right. There are other fees. I'm talking about income tax, and I'm talking about probate, right?
Yep.
If you have somebody preparing the terminal tax return on behalf of the estate. So I'm the executor, fine, but guess what? I know nothing about taxation. So now I'm going to hire an accounting firm to help me with this tax return for the estate. Well, we've got to pay for that. Right? Or I'm not familiar with the probate process, so I'm going to go to my lawyer and have my lawyer help me to engage this probate process. Then there are going to be fees associated with that, right? How much are the accounting fees going to be? How much are the legal fees going to be? Really, it just depends on the lawyer you're using. Depends on the accountant that you're using, right? If you set up a trust and you're going to have a trustee who's going to manage this trust going forward. Maybe the trustee's a family member and won't charge a fee. Maybe it's an external firm you know, and they're going to want to charge a fee of maybe 3 to 5% of the value of the assets, right? Maybe it's a family member who feels they should be paid to manage the trust, right? And then, you know, they too would typically be entitled to 3 to 5% under legislation, although you can specify a fee in your will and that type of thing, right? So these are other fees that we haven't addressed in great detail in this presentation. But they are certainly fees that can be added to the cost of managing one's estate, in addition to income tax and probate fees.
Absolutely.
Right.
Based on the numbers I've looked at, on average for Ontarians, it works out to be about 4.5 to 6% of your estate value.
Yeah, it can be, right? Yeah. Okay. So let's take a look at an example of how income tax and probate fees can take a bite out of the value of assets. Colleen, a widow, has an adult daughter who will receive her assets via her estate upon her death. Among her assets, Colleen has a RIF, the value of which is $600,000. The beneficiary of the RIF is her estate. Upon Colleen's death, assuming a resident of Ontario, income taxes and probate fees for the RIF would be as shown here. Income tax, you're looking at $321,000. That's just for the RIF. It doesn't consider any other income earned for the year of death. And then probate fees of $8,200, right? That's just in respect to the RIF, right? So the point is that these income taxes and these probate fees can add up. And there are some strategies that one can engage to try to minimize these taxes and fees. One very common strategy is to leave assets to a spouse, right? If you're leaving a surviving spouse, Canada allows you to transfer assets to a surviving spouse on a tax-deferred basis. So the first spouse to die, you know, there typically isn't a lot of taxes payable there. There may be some probate fees depending on if any assets are solely owned, but there typically is an income tax if you're leaving assets to a spouse. But when that surviving spouse passes away, that's when the tax man quite often comes calling, right? So we just want to be mindful of that. So let's get into some strategies. Got about 10 minutes or so. Let's get into strategies for reducing taxes, managing the distribution of assets. First one is have a will, right? Have a will. And the reason we say this is simply put, if you don't have a will, you're automatically engaging the probate process, right? There are some situations where you don't need to engage the probate process, depending on the type of assets that are in your estate and how they'll be distributed. But if you have no will, you have no executor. If you have no executor, somebody has to apply for the right to administer your assets. They apply for that right through the provincial government. So hence the probate process is automatic. Okay. So if nothing else, having a will can help you to avoid the probate process, depending on the other assets that you have. And again, some stats here from the National Institute on Aging. 91% of Canadians think wills are an important component of an estate plan, but only 48% of Canadians have a will. Okay. 16% of Canadians believe there are no consequences or don't know the consequences of not having a will. And less than a third of Canadians say they have an estate plan. Right. When an individual dies without a will, they're deemed to have died intestate. Right? That's the term that's used to describe when somebody dies without a will. So when somebody dies without a will, there are some challenges, right? What were the testator's wishes? Automatic probate, because an administrator would need to be named. The province defines how those assets should be distributed when you die without a will. Province decide. The province doesn't take the assets, they just decide who will receive the assets. Now, the rules say that your spouse will receive the first $350,000 worth of your estate. Any excess is divided between your spouse and kids. And some might say, okay, well, that's fine. I'm okay with that, right? But if you go a little bit deeper, that distribution in and of itself might create problems, right? Because, one of the things is if you intend to leave the majority of your assets to your spouse, but then your kids become entitled directly through intestacy, that can create a problem for a surviving spouse. Perhaps the surviving spouse has to sell some assets now, or give up some assets in order for the children to receive their entitlement. That can be a problem in some cases, right? Right? Entitlements for minors, when minors inherit under intestacy, then you're adding complexity and perhaps slowing up access to those assets because the public trustee now has to give their consent to access that money, so family can access that money for minors, right? And then there's immediate taxation. We said earlier that you can transfer assets to a spouse or common law partner on a tax deferred basis. If children inherit under intestacy based on the provincial rules, you're accelerating taxation because you typically can't transfer assets to kids on a tax deferred basis, right? So there's a number of reasons why you might still want to have a will, even though the provincial intestacy rules on the surface might appear to align with your wishes. Here's another thing to think about to minimize taxes at death. And I alluded to this a little bit earlier in the presentation. We said if we leave everything to be taxed when we die, we're looking at potential taxes of up to 54%. Well, to avoid that, you can consider taking on additional taxable income before you die, in the years before you die, in your retirement years, perhaps. If you're subject to lower tax brackets and lower tax rates today, maybe you take on a little additional taxable income today, pay your taxes at a lower tax bracket, lower tax rate today to avoid 54% later on, right? So a strategy is trigger additional income in retirement to avoid top tax rates at death. The other thing to consider is tax deferred transfers. We said that we can transfer assets on a tax deferred basis to a spouse or common law partner. We do that with non-registered assets. RSPs and RIFs can also be transferred to spouses, common law partners, or children with minors, or children who are minors. There are tax deferred options there. So you can kind of consider that. All right. Let's look at another strategy. Name beneficiaries. Name beneficiaries for RSPs, RIFs, TFSAs, and insurance contracts. This is a common one. You've got a registered plan or you've got an insurance contract. It allows you to name a beneficiary right on the contract. And in doing so, when you die, the asset typically bypasses your estate, goes directly to that named beneficiary, so it can avoid some probate fees, right? It also provides quick access to the funds by beneficiaries. And for RSPs and RIFs, there are still some rollover opportunities available there, right? What we caution Canadians about, though, is if you are having named beneficiaries for RSPs and RIFs, if these assets are not to go to a spouse, remember that they are taxable at the time of death. That tax bill is a liability of your estate. The named beneficiary on the RSP or RIF receives the full value of those assets in a very quick way, but the tax bill goes to your estate. So this can create a conflict if your estate beneficiaries are not the same as the beneficiaries on your RSP and RIF. The estate can end up paying the taxes for the RSP or RIF that went to somebody else, right? So we want to be mindful of where the tax bills fall when we're using named beneficiaries for certain registered plans, to ensure that we don't create a conflict through that scenario. Okay. All right. Next, joint tenancy. All right. I want to take a couple minutes and talk about this because it's important. I often hear about folks listing assets jointly to avoid probate fees, or because they think it's simple, or because they want somebody else to manage their assets for them as they get older and can't manage assets for themselves. They often consider joint tenancy, adding somebody as a joint owner on their assets. And this is common with spouses, and it typically works really well with spouses. But it can also be used with adult children, parent and adult child. But there are risks. associated with listing your assets jointly with an adult child, right? Number one, who's going to have signing authority? Will everybody be required to sign? In which case your kids can hold you hostage, or can anyone sign on their own? In which case you can show up and have no money left because your kids got at it, right? Do the children have creditors? And if so, will they have access to that joint asset? Is the child in an unstable relationship? And if so, might the asset become subject to distribution on a relationship breakdown? Not saying that it will in all cases, but somebody's going to look at the asset, I'm sure, right? These are all things to think about before you list the asset jointly with a child. But the other thing to think about is if you are going to add a child as a joint owner on your assets, are you adding all the children if you have multiple kids? Or are you adding just one or the other? And is your intention at the time of death to give that asset solely and directly to that joint owner? Or is your intention for that asset to be split amongst all your children? This can create a lot of conflict and confusion at the time of death if the intentions are not clarified before death. I'll give you a quick example of what I mean. Here we have Tony. Tony's recently widowed, and he has two kids, Scott and Kevin. Okay. Now, Tony has an investment account. I don't know, 100,000, 200, 300. The amount doesn't really matter. In this case, we use 300. Tony has a $300,000 investment account in his name solely. Now, he's getting up there in years, can't get to and from the bank like he used to, requires a little bit of support when going to appointments and so on and so forth. And Scott, one of the two kids, lives really close to Tony, spends a lot of time with Tony, comes over, checks on Tony, helps him with his finances, takes him to his doctor's appointments, and so on and so forth, because he's there, he's close, he's nearby. The other child, Kevin, lives much further away, an hour or two away, young family, doesn't have as much time to spend with Tony, but loves his dad as much as his brother loves his dad, and dad loves both kids equally, right? Now Tony decides, this is dad decides to add Scott as a joint owner on this account because dad's getting a little older, can't get to and from like he used to, right? Scott spends a lot of time with him, takes him to his appointment, and he thinks, look, I'm just going to add Scott to the account. It'll make things easier. And I might also avoid some probate by doing this because I hear that with certain joint accounts, right, of survivorship, you can, at the time of death, the asset bypasses the estate and goes to the surviving joint owner. So if we can avoid probate, fine. Now, Tony has a will. He does not mention the joint account in the will, but his will says that any estate assets are to be divided equally between his two kids. Shortly thereafter, Tony dies. When he dies, Scott, the joint owner, contacts the financial institution and says, Dad's died, here's his death certificate. Please transfer the account to my name solely. And they do that because Scott is a joint owner. Shortly thereafter that, the sibling, Kevin, contacts Scott and says, hey, Scott, sad to see Dad go, loved him so very, very much. I know you were managing some of his assets, and I'm just wondering when you're going to pay me my share of that joint account you had with him. Scott turns to Kevin and says, excuse me? I was here taking care of Dad in his retirement years. I was taking him to his appointments. I was helping him with his finance. Dad wanted me to have this account to compensate me for my efforts. Kevin says, you're crazy. You know Dad loved us equally. The only reason your name was on that account was because you were helping him with his day-to-day, but you know that Dad wanted that account to be divided equally between the two of us. So now we have a conflict. Now we have warring siblings. And we don't know what Dad wanted because Dad wasn't very clear about what should happen to the account at the time of death. Quite often when we list accounts jointly, They don't ask about what your intentions are at the time of death. You don't put that on the documentation quite often. And dad made no reference to the joint account in his will. He just said that any estate asset should be divided between the kids. So these kids now might end up hiring lawyers. Lawyers might try to resolve it. Lawyers might not be able to resolve it. So we end up in front of a judge. Judge has to figure out what to do with this account. And if there's no evidence from that to suggest what should happen, they have to make a call. They would normally look at two presumptions, presumption of advancement or a presumption of resulting trust. If the relationship between joint owners is parent and minor child or spouse to spouse, quite often the courts would rule in favor of presumption of advancement, meaning the asset should go solely and directly to the joint owner. If the relationship is anything other than spouse to spouse or parent and minor child, let's say parent and adult child, the presumption of resulting trust would often apply, meaning the asset should be deemed to flow through the estate and be divided according to the will. So in this particular case, because we're talking about parent and adult child situation, the account would likely flow through Tony's estate and be distributed according to the terms of his will, which suggests that it should be divided equally between the kids. And this is just simply because the intentions were not made clear at the time of death. The moral of the story here is be careful with joint accounts between parent and adult kids, especially if there are multiple kids. Be careful with how you set that up and be clear about what your intentions are at the time of death to avoid conflict after death. Okay. The last thing I'm going to talk about here real quick, before I just make one or two comments on executors, is you might want to consider trusts as part of your estate plan. What is a trust? A trust is a relationship in which a settlor gives property to a trustee who holds the property via a trust for the benefit of beneficiaries. That's just a fancy way of saying, I don't want to leave my beneficiaries with assets directly. I want to put a trust in between. I want to put the assets into the trust. My kids, for example, will be beneficiaries of the trust, but I want somebody else to manage that money for them. I want somebody else to distribute that money to them over time as opposed to all up front. So trusts are typically used to manage and control assets before or after death. That sounds strong, manage and control assets. Some say control it from the grave. It's not necessarily and always because the deceased has control issues. Quite often, it's because kids, for example, don't have the ability to manage assets over time responsibly, right? And this is where you might want to put a trust in place. So trusts are typically used when control is desired or required, and it could be helpful for spendthrift beneficiaries, beneficiaries with disabilities, minor children or young adults, or those who have creditor concerns. Trust can help. I'm not going to go through the advantages and disadvantages in the interest of time, but there are two types of trusts. You can set up a trust while you're living. We call it an inter vivos trust. Or you can set it up at the time of death. We call it a testamentary trust. There are advantages and disadvantages to those, to both types of trusts. You can talk with Bronson and team, and he can walk you through that. Okay. So just before I close here, I think I'm at time, if I'm not mistaken. I don't have my watch in front of me, Bronson, but I think I'm pretty close.
We're 1 minute over.
1 minute over. Okay. So let me just say this about the executor, and then I'm going to close. So executors are required or expected to carry out their duties in the same way a prudent person would manage his or her own affairs. So executors are expected to act honestly, judiciously, and in the best interest of all beneficiaries. Even though an executor might also be a beneficiary of an estate, if they're carrying out the role of executor, they have to put on their executor hat and be fair to all beneficiaries. They cannot lean the estate one way or the other to benefit one beneficiary versus another. Otherwise, they can run into some personal liability. Okay? So executors should avoid conflicts of interest, act reasonably when exercising discretion, protect estate assets from significant losses, treat all beneficiaries fairly and objectively. It is a job. It requires work. executors are required to quite often manage funeral arrangements, take inventory of and secure assets, file for probate, advertise for creditors, particularly if there are debts and liabilities in the estate, filing the final tax return, paying debts, including income taxes. In fact, you can't distribute any assets from the estate until all debts are paid. Dealing with challenges to the will, accounting the beneficiaries, distributing the assets eventually, and keeping accurate records. All the responsibility of an executor. So it is a job that can come with honor. I feel honored. I've been named executor, right? And that's cool. But it's work too. So we want to be mindful of that. You want to choose somebody who has the ability and time to carry out these duties. Okay, so in preparation for the role, executors should sit with testators, this is the communication piece here, to review the will and understand wishes, determine the location of key documents, identify and discuss funeral preferences, suggest a list of assets and liabilities, and understand the role, duties, and obligations. All right, if you do that, you're well on your way to reducing conflict and having a more fluid and efficient distribution of estate assets. I'm going to stop there because we're past time. I'm going to turn it back over to Bronson for whatever's next. Over to you, sir.
Amazing. Thank you very much, Wilmot. So that was a lot of information packed into about 40 minutes. So thank you very much for that. I do have a little bit of time. So if you guys are not pressed for time, feel free to stick around for a couple questions. Wilmot, it's up to you if you want to stay. I'd love if you can, but I'll be around for the next 10 minutes. But just before we close, I've got a couple of key takeaways for everybody to think about and make sure that these are pieces that you have in place. And if not, you should probably reach out because we can help you with this. So number one, make sure you have a will. I'm not a lawyer. We don't have a lawyer on our team, but we do have a law firm in town that we do refer a lot of business to. So if you do not have a will or you need to have your will updated, please do reach out and we can refer you to a lawyer who can help you with that. As Wilmot mentioned, this is potentially a way for you to avoid probate. Nobody wants to go through the probate process unnecessarily. It's a waste of time. It's a waste of money. So if you have the right pieces in place to avoid that, get that in place. Secondly, if you're worried about your RSP situation, we can figure out a way to make sure that you efficiently draw down enough to deplete that as soon as possible, if it makes sense. A lot of times, as Wilmot went through, start drawing it down as soon as you hit retirement, right? Don't just take what you need for expenses. A lot of times it can make sense for you to draw down more than you need and reallocate that money potentially into a TFSA if you have the room, or there are other strategies. Name your beneficiaries, every account where applicable, insurance products, so including segregated funds, which are an insured investment product. So if you do have non-registered assets potentially with the bank, banks do not issue segregated funds. Only insurance companies do. So if you have non-registered mutual funds, GICs, cash, that will be subject to probate. But you can avoid probate if it's in an insurance product like a segregated fund. Every registered account can have a beneficiary listed. Make sure those are listed on file. Okay, and lastly, I've got, be careful with joint tenancy. The bank especially, I keep picking on the bank, but they piss me off sometimes because they tell people just do joint tenancy. And that's not always the right scenario for you. So make sure that you consult with a financial professional who knows what they're doing, not just a teller at the bank or not just a base level financial advisor at the bank, because often they're brand new to the industry and aren't necessarily aware that they're not giving you correct information. So always double check information, whether you're chatting with me and you think something seems weird, double check, right? We're living in an information age. You can ask ChatGPT the same information that I give you and you can fact check me, right? I encourage you to do the same thing if you're working with another financial advisor or if you have a relationship with the bank. So those are my key takeaways that I want everybody to leave with. If you take nothing away from this session, the thing that I want you to take away is you need to make sure that you have a plan. Whether you know what the plan is now or not, if you do not know it, that's a problem, right? So make sure that you have some plan and you understand that you can't just assume that things will be taken care of because you set it up 20 years ago. Oftentimes things change in your life and you need to consult with a financial professional to make sure that your plan is still applicable to your situation now.